Imagine waking up one morning and discovering that millions, no billions of dollars, have vanished overnight. Pause companies that promised to change the world, to reshape commerce, technology, communication, all crumble into dust. Investors who thought they were on the fast track to unimaginable wealth are left with empty portfolios. Slight pause. How could this happen? How could the rise of the internet, now the backbone of modern life, create such spectacular fortunes and destroy them even faster? Today, we dive deep into the dot-com bubble, a story of greed, innovation, and human behavior. This isn't just about money. It's about psychology, speculation, and the very mechanisms of financial markets that can lift a technology to the sky and then pull it down without mercy. Step back to the early 1990s. The internet was just a tool for academics, hobbyists, and government institutions. Few foresaw the digital revolution ahead. Yet, even in these humble beginnings, the seeds of a financial frenzy were planted. The 1990s were a time of optimism. The Cold War ended. Globalization surged. Technology stocks began outperforming traditional industries. Companies like Microsoft and Intel showed tech could create enormous value. Investors wanted the next big thing. Enter the dot-coms Amazon, Pets.com, webvan companies with little more than a website and a dream traditional metrics, profits, revenue, suddenly seemed outdated. The mantra growth at all costs, visionaries like Jeff Bezos emerged, alongside charismatic CEOs of now forgotten dot-coms, selling dreams with just a slide deck. Venture capitalists poured billions into startups, sometimes before there was even a product. The internet promised access to information, new markets, and a global customer base. Investors saw opportunities not just to make money, but to participate in a transformative movement. Pause. The Nasdaq Composite, weighted heavily toward tech, began to soar. By 1995, each new internet IPO seemed destined for meteoric rise. Media fueled the hype. Every IPO was a can't-miss investment. Ordinary people rushed in, brokers encouraged it. Soon, companies without profits went public. A culture of speculation took root. Traditional valuation methods were ignored. If you had .com in your name, investors assumed exponential growth. Hype drove investment. Investment inflated stock prices. Inflated prices fueled more hype. The cycle reinforced itself. By the late 1990s, the craze was in full swing. Companies went public at dizzying speeds. Some, like Amazon and eBay, laid foundations. Many others had no plan beyond a flashy website. The Nasdaq tripled between 1995 and 2000. Take Pets.com, a cultural phenomenon. Before its IPO, millions watched its sock puppet mascot on TV behind the marketing. Costs were unsustainable. Shipping expensive, margins razor-thin, customer acquisition, astronomical red flags ignored because stock prices kept rising. Irrational exuberance reigned. Warren Buffett warned against investing in companies without earnings. Few listened. Cause and effect. Technology promised the future. Speculation fueled investment. Inflated prices reinforced success. Early 2000. The breaking point. Nasdaq peaked over 5,000 points in March. Cracks appeared. Companies missed earnings targets. Venture capital dried up. Investors realized not every .com could be Amazon. Confidence faltered. Stock prices plunged. Panic set in. Investors rushed to exit. Companies went bankrupt overnight. Employees lost jobs. Fortunes evaporated. Pets.com, once worth hundreds of millions, folded within months. This was more than financial. It was psychological. Dreams of instant wealth collided with reality. Trillions of dollars in market value vanished. The tech sector reeled. After the crash, the Federal Reserve and regulators tried to stabilize markets. Interest rates adjusted. Some measures encouraged responsible investing. But the bubble left lasting scars. Startups that survived returned to fundamentals. Amazon focused on profitability and efficiency. Others, like Webvan, became cautionary tales of overexpansion and blind optimism. Corporate governance reforms, stricter accounting standards, and skeptical media emerged. The bubble exposed flaws in evaluating technological innovation. Markets became cautious. But history shows these cycles repeat. The dot-com story isn't history. It echoes today. Cryptocurrency booms, SPACs, AI startups, the same patterns emerge. Hype, speculative investment, unsustainable business models. Shocking data. During the 2020s crypto boom, trillions flowed into digital assets with little oversight, echoes of unchecked capital from the dot-com era. Investors bet on ideas, branding, and promise over profits. Lesson: human behavior in markets is consistent: fear of missing out. Herd mentality, overconfidence. These drive bubbles, regardless of century or technology. Lessons from the dot-com bubble. 1. Beware of hype over fundamentals. Growth is exciting, but sustainable business models matter more. Pause. 2. Market psychology drives bubbles. Emotions, greed and fear, inflate or deflate valuations faster than logic. Pause. 3. History repeats. Knowing past bubbles helps spot warning signs before it's too late. Pause. The dot-com bubble warns us, the lure of fast money blinds even the smartest investors. As tech evolves, new bubbles appear. The question: will we learn or repeat mistakes chasing the next internet dream? If this deep dive enlightened you, hit like, subscribe for more financial history and market insights, and share your thoughts below. Have you witnessed a modern bubble? How does it compare to the dot-com era? Let's discuss and learn. Because history has a way of teaching lessons we need most.